Hello and welcome to this course on finance for non-finance managers. Today's topic is capital expenditure transactions. The aim of this micro lecture is to enable you to have a clear understanding of capital expenditure transactions. And there are three learning objectives today. The first learning objective is to ensure you can effectively define capital expenditure. That's just not a matter of learning off a definition, that is a matter of taking ownership of a definition where you would feel confident enough to explain it to a third party. The second learning objective is as follows: to ensure you can correctly record capital revenue expenditure in the books of accounts. And this is hugely important, that you understand the debits and the credits of the transactions so you can spot when somebody makes a particular error in relation to recording such transactions. And finally, the third learning objective today is to make sure that you fully understand what happened at WorldCom, where they messed up in relation to recording capital expenditure transactions. And in fact, they actually did it deliberately. So those are three learning objectives today. So let's move on then to a definition of capital expenditure. So capital expenditure is incurred when a business spends money on either of the two following items. The first one being when they buy a fixed asset, and the second time being when they add value to an existing fixed asset. Okay, so that might be a situation where a business buys a hotel building, let's say for $10 million, and then subsequently after that they decide to put on a $1 million gym to keep their customers trim, let's just say. So now you got capital expenditure of $11 million. So it's not just the original purchase. Now there's other items that need to be considered when you're making a expenditure on capital items, and we need to look at those. There's three things in particular we need to draw our attention to, and they are as follows. So when capital expenditure is incurred, related costs also need to be accounted for as capital expenditure items. The first one being legal costs associated, for example, with the purchase of a property. I mentioned the situation there where you purchase a hotel. So if you purchase a hotel, you're more likely will be engaging the services of a legal firm to deal with the conveyancing. And that could be quite a high monetary value. So it needs to be added to the value of the purchase of the property. So going back to our previous example, if you spend $10 million on a hotel and it costs you $100,000 worth of legal fees, the 100,000 gets added to the 10 million, and that's all capital expenditure. Another couple of items you need to be aware of would be things like transport costs. So let's just say you're buying some machinery in America and you're exporting them over to Europe. The cost of the transport would also need to be added on to the actual price of the equipment you're purchasing. And then finally, any other costs that are incurred in order to get the fixed asset into operation in your organization. So if you have to get some kind of technician or what have you to integrate some machinery into your production line, that would also be the case. So let's have a look about how you record capital expenditure transactions. So what you need to do is debit the asset account and credit either a liability account or reduce your bank by crediting it with the transaction fee. So here you go. If you buy a hotel for $10 million, you would debit property account with $10 million. And let's say you were borrowing from the bank, you would credit a loan account with $10 million. And that is it in a nutshell. So finally, let's just have a look at what happened at our friends at WorldCom. They were a US telecoms company, and in the years 2001 and 2002, they falsified their accounts. So what did they do? Well, they simply got $3.8 billion worth of operating expenses and treated it as if it was a capital item. And the impact this had was it took out $3.8 billion worth of operating expenses from their profit and loss account and dumped that figure into their balance sheet. And what that means is that their profits shot up by $3.8 billion. Don't do this because that's fraudulent. So based on what we've just covered now, it would be a good opportunity for you to have a go at the micro quiz.